Bull versus bear. Stock battle.
Okay.
A little nervous.
Are you ready, Brennan?
I'm ready.
Go.
Ryan will likely talk about the company's solid current fundamentals, but the forward fundamentals may be in for a bit of a bumpy ride. The off-road motorcycle market received a huge COVID bump, with the US market growing by 40% in 2020, but anticipated to grow with just a CAGR of 5.5% over the next 6 years. Plus, momentum in revenue growth is slowing, with Q2 2022 revenue down 26% sequentially for the first sequential decline since June of 2020. Leatt operates in a very mature market with a lot of competition, as competitors have flooded the market with similar neck brace products, with Leatt's neck brace sales declining 18% year over year, and over 15 companies compete for market share in the helmet and body armor market. The company's products are predominantly manufactured in China, which is a risk, and the stock is thinly traded with just 5,000 shares trading hands per day. Bottom line, I wouldn't want to hold this stock after the COVID bump and into a macro environment with less consumer spending. Boom.
You've got 2 seconds left.
Brian sucks.
All right, you don't want to use that time. Okay.
Good point, Brennan.
Well, we'll see. We'll see what Ryan's counterpoints are. Ryan, are you ready?
Yeah.
Go.
Leatt is growth at a reasonable price. Despite facing tough comparables, Leatt's revenues, net income for the first 6 months jumped 55% and actual EPS jumped 46% to 120. Q2 was the 17th consecutive quarter of year-over-year revenue growth. Has a great balance sheet, significant cash position, $5 million or 86 cents per share, $33.48 million in working capital, and basically no debt. With all this, it must trade at sky-high valuations. Wrong. Leatt trades at 8.9 times trailing 12 months earnings. Growth is expected moving forward. It is not just the financials. Leatt boasts award-winning products that meet the highest safety standards in sport. Safety is top of mind today for athletes and parents. Leatt innovates. Newly launched helmets, growth up 132% in Q2. It's unknown and on the OTC, making it textbook GARP opportunity, growth at a reasonable price. And all that came from Brennan, so I would disregard anything he said. Thank you.
Okay, 1 second. 1 second to spare. Excellent. Nice. Can I clarify something here?
Yes.
I thought I heard Brennan say that quarterly sales were down, and then Ryan was saying that quarterly sales were
that
up.
was just in one segment. Really? Because
they were only up in one segment.
Sequentially. Total quarterly sales sequentially were down for the first time since the pandemic.
But
so sequentially,
up year over year. Up year over year.
Yes, up
so
year
they had
over
a
year.
bad quarter, is what.
So that is, at. Yeah. Well, it was up year
I
over
would
year,
argue
so
that
it's
they
not
had
really
a
bad
COVID
quarter.
bump, but
Despite those tough pandemic comparables, Aaron, they still had significant growth and only trade at 8.9 times with
okay,
net
enough. Thank you.
Growth.
I appreciate that. You're now you're starting to exceed your time.
Yeah. Hey.
Yeah. I mean, this is a tough one. What? Like, do you think this is a tough one, Brett?
Yeah, it is. I will say something which Brennan didn't comment on was actual earnings as much, where Ryan did. He was saying there was 17% EPS growth.
Well, I just said they had good fundamentals. I knew Ryan was going to gloss it up because the fundamentals do look good. But forward, I think that momentum is declining. And that is a scary thing, especially when you're dealing with consumer discretionary products.
Am I caring about sales or am I caring about earnings? That's the question here.
Well,
I mean, earnings growth to me is less attractive if it's not driven by revenue growth.
So
right?
their core product, and I'll just let you know too, their core product sales were down, but their ancillary new products, they have a new helmet product just really introduced recently, but in that quarter, it was up 132% sales for the helmets.
Small base.
Head injuries.
Small base.
Aaron, you want to protect your children. Just think about this. You want to protect your children. Think about the children.
Yeah. No, I'm thinking.
Are you going to that argument?
And at 8, you're protecting them at 8.9 times earnings, and we didn't even take the cash out. It's probably 8 times when you take the cash out.
Okay, yeah. Now you're starting to exceed your time again, sir. Yeah. Brandon got a few comments in. Yeah, no, I think I've heard enough. It's It's a tough one. It's a tough one because, you know, for some of these companies that have gotten a big pandemic bump, for some of these companies, you know, we really have seen sales come off, and I've often said, you know, it's worthwhile to just, especially if there's negative momentum in the stock price, just to kind of see where sales start to trend, right? Like if there's not a hurry to jump in with like a full position, why not just see how sales are trending, or maybe like build it up very slowly if it's a company that you like. Because in a lot of cases, it's the end of the pandemic was devastating financially to some companies that did very well. But they're coming out with new products.
There's still growth. And yet there's still growth.
Yeah. Yeah, I heard you.
Post-pandemic.
Do we need to start issuing yellow cards here, sir?
I might have to start muting him.
No, it's all good. It's all good. You know, after careful deliberation to this, I'm going to have to say that I call this for a draw.
No, stop.
Joking. No.
It's like kissing your sister. What is it, a hung jury?
No,
I think it is a hung jury.
Yeah, you know, I think that
yeah, speak your mind.
I could call this either way.
Brett,
right?
what do you think?
It is.
I'm not calling it either way. But sure, I'll let you talk, Brett. But
yeah, something which I do. I am so on the edge here because there is just great points on both sides.
But we got to do this. We have to do this. We're wasting people's time now.
I think that
people have left.
I will say mine first.
Yeah,
you can try to convince me, but I'm going to go with Ryan.
You're going to go with Ryan, okay?
Yeah, because he mentioned the balance sheet, which Brendan did not have any counterpoints against that. That's what's pushing me over the edge there, is they have a good balance sheet. So if they're looking at like a year of bad quarters in a recessionary scenario, they do at least have some backing towards it.
Okay.
That's what I'm getting out of it.
Okay. Yeah, I'm gonna go with Ryan as well. And it was so close though. It was so close, Brendan. I think that Brendan did do a good job. But this is also just a situation of like,
except he sucks.
You know,
Just kidding.
You've got fundamentals in line. You've got evaluation. You've got, you know, I mean, I wasn't, you know, we need to be cautious that momentum is declining. And the problem is that I wouldn't just jump into a full position in this. And this is what is making it a difficult decision, right? But I think that Ryan, you know, at least made a good enough case that I would consider, you know, layering in to something, right? So but it was like super close.
Now that I've won. Those would be my worries, like that. Yeah, there is you know, you could have a quarter where there's a decline in earnings per share, right? You could have,
and that's the thing.
Decline.
Like there was still.
I was very encouraged though to see the growth in the other products outside their core product, right? That was excellent to see. It shows they're innovating. I think their product is well thought of, and the name is now well thought of. You know, through a couple of industries now, and that, you know, helps when they bring on another product. And if you're well thought of and you know, have great reviews, then, you know, that can help the growth in that product going forward. But yeah, like the issue is some of these companies did get massive bump ups, pandemic, stay at home. Everybody went out and was biking or whatever the product was that was used more during those times. And you have to watch now. If this company had a quarter where we saw significant negative decline or revenues decline significantly year over year, then, you know, you just wait on the sidelines, but we didn't see that. So, you know,
and I just think for a quarter position, for something to kind of start nibbling on it, you know, net cash balance.
It's difficult to
and low valuation.
Like they don't have guidance going forward, which is something Brandon could have said.
No.
Yeah, well, but the thing is like it's tough because they've increased their international sales so much. Like they're really growing internationally now, and management has talked, like the only guidance that they've really given is we have a long runway to continue to grow into this international expansion they've been talking about.
It'd be nice to see them uplist too. Like
one of the most persuasive things that Brandon said was when he said that future growth was expected to slow and the market was going to grow at 5.5% per year. So, okay, so that's slower growth, but obviously with the valuation, you're not expecting the current growth rate to be maintained, right? But I would say in the future, if you could find like some statement that kind of like broke things down a little bit from like, like an industry report or something from like the conference call or a competitor that talks about like the industry actually, slowing, that would have helped as well.
To be honest, like a 5.5% or
that could be fine. And if they're increasing market share,
rate.
then you're at 10-15% revenue growth, maybe.
Like say in the helmet part of the market, they're a minnow right now. If they have a lot of market share to gain, then you have the case to gain market share and grow above the industry. So if you're trading at 8 point something times and you're growing, you could maybe grow double the industry, 10%. Then you're probably, even at that rate, you're probably looking at a company that it could be undervalued.
Right.
But certainly the issue is it's going to have more tough comparables going forward. So do you have a couple quarters where they have an earnings per share decline? And then, this may be a very good company, but you might have a pullback. Then that might be the opportunity to
and you will.
Buy a lot more. Right?
And you will in this market.
And
so that's why it was a good debate, we thought. We looked at it, and these were the two sides of the coin. And, when you're looking at a company like that, it's nice to actually have a good debate where you have two judges saying, either way.
Yeah, you want it to be hard, right? You don't, we've discussed, we don't want to do these debates where it's won or lost at the flip of the coin. We want each person to have, a good opportunity. Exactly.
And even though I did lose, I will pat my back. I was the analyst that pulled this stock out back at the beginning of the pandemic as a part of the LD 500 companies. And just like to quickly sum it up, I mean, it's basically exactly what Ryan said. Great valuations, great balance sheet. They started with their flagship neck brace. After that, they started providing a full neck to toe or head to toe offering. Good growth and growth to scale into. We kept the stock at a monitor, but I mean, it performed very well at that time. It was at $5. I think it's at $22 now. So it's just a good business that, great fundamentals. And, like Brian said, textbook, GARP, or growth at a reasonable price.